Hello and good afternoon and welcome to today's Euromoney live stream. I'm Richard Banks and I'm your host, as is often but not always the case. This is part of our housing finance and mortgage-backed securities series, which we're producing in association with the Real Estate Development Fund of Saudi Arabia. But today's topic is somewhat different in that we're going to be getting the international perspective on MBS, mortgage-backed securities, through a conversation with Seth Appleton, who is Principal Executive Vice President at Ginnie Mae. Welcome, Seth. It's great to have you here. You're on the East Coast, is that right, of the US?
That's correct, in Washington, D.C.
And how are things in Washington? No, not politically, but in terms of just the weather and everything. Is autumn here?
The autumn has arrived, and it's been a very fascinating time to be in the mortgage-backed securities business. So I'm looking forward to today's conversation.
Well, that's great. We're going to talk for about 50 minutes, as always. There's plenty of time for questions. I would like you, our audience, to put your questions to me in the Q&A. If you really want to put them in the chat, you can. It's slightly easier for me to manage if you put them in the Q&A. I know that some of you have questions because you've told me that you will in advance. We will have a dedicated session at the end for questions, but also we'll take questions throughout if they are relevant to the topic at hand. So Seth, just tell us a little bit about yourself. How long have you been at Ginnie Mae? What did you do before? And what do you do whilst you're at Ginnie Mae?
So thanks for having me today, Richard, and appreciate all of the audience members joining from all over the world. I've been the Principal Executive Vice President, which is the senior official at Ginnie Mae, for a little over a year now. I'm concurrently serving as the Assistant Secretary for Policy Development and Research at HUD, the U.S. Department of Housing and Urban Development. I've been at HUD for about 3.5 years now. And before joining HUD, I spent about 13 years working in the United States House of Representatives. So I've been around housing policy and housing finance from that perspective for most of my career.
So just if you could, for those of us perhaps who not 100% clear on all the different characters in the drama that is the US housing market. Who are HUD and what is the relationship between HUD and Ginnie Mae? And then we'll move on to talk about Ginnie Mae particularly in a moment.
So HUD is a cabinet agency of the United States government. Our cabinet secretary is Dr. Ben Carson, and the agency has about 7,000 employees and has a variety of programs which are really focused on a diverse set of priorities, including providing rental housing assistance to low-income families, providing community development grants to cities and counties and states. And then it's got a large footprint also in the public housing sector. And then it has a whole separate really set of functions on mortgage finance. And those are in two different organizations. One is the Federal Housing Administration, which is the world's largest mortgage insurer and provides mortgage insurance for low and moderate income, minority, and first-time home buyers primarily who may not be able to access credit in the traditional market. It's got more than $1.2 trillion of insurance in force right now. And then there's Ginnie Mae, which is a wholly owned corporation within HUD. And Ginnie Mae provides a full faith and credit guarantee explicitly on mortgage-backed securities that contain loans from the Federal Housing Administration, the Department of Veterans Affairs, another cabinet agency, the Department of Agriculture, which is a third cabinet agency, and also HUD's Office of Public and Indian Housing, which is another office within HUD. So very interrelated with FHA and with the other government mortgage finance agencies that are part of the U.S. government. We've been around at Ginnie Mae for more than 50 years, have helped finance loans for more than 53 million Americans. And really our key function is to attract global capital to provide liquidity for the government insuring and guaranteeing programs that serve the American homeowners that participate in them. And to make sure that we have, sufficient liquidity and that it's an attractive investment and a safe investment. It has a full faith and credit guarantee. So as an investor, you absolutely will get paid in full and on time, no matter what the circumstances.
You've used that wonderful expression, a full faith and credit guarantee, twice already. And the sort of flip side of that is that there are other entities which share similar names, the Fannie and Freddie, Fannie Mae, Freddie Mac, which have an implicit guarantee, but not the full faith and credit. What, in terms of the difference between you and they, is it just in terms of the guarantee, or is it in terms of ownership, purpose, that type of thing?
No, that's a great question. There's a variety of differences, though. Kind of, we both operate in the secondary mortgage market. The GSEs, Fannie Mae and Freddie Mac, are shareholder owned, though they're in government conservatorship right now. As you mentioned, they have an implicit guarantee to cover investors. They cover conventional loans, which are different than kind of the government mortgage loans that we cover. And really, there's borrower credit risk, interest rate risk, and servicer risk involved in those. The thing about Ginnie Mae is that we don't issue the securities. We just guarantee that they will be paid, the investors will be paid principal and interest on time and in full. The GSEs actually are the issuers of the securities. So it's a little bit of a different setup from that perspective as well.
So a security, or more likely, a basket of securities that have the Ginnie Mae full faith and credit guarantee, who is issuing those securities, and how does the process work?
Yeah, so what the Ginnie Mae issuers are a number of private entities. They're both depository institutions and increasingly what we call independent mortgage banks or non-depository institutions. They might originate the loans themselves or aggregate them and hold them, but they are approved to issue securities in the Ginnie Mae program. They pay us a guarantee fee of 6 basis points for our coverage on them, but they are responsible for collecting the payments from borrowers and making sure that those are advanced to investors. Obviously, if something happens and they're unable to do that, we have protocols to make sure the investors get paid and to take appropriate action.
But you are, I know, because we've had you come to your predecessor, Marion Casper, came to speak at our live Saudi housing conference in Riyadh last year. So, you have a role also in communicating to international capital.
Absolutely.
But it's not, but if I decided today that because I'd listened to you, I wanted to buy, £20 worth of Ginnie Mae backed securities, I couldn't do that. You're not marketing securities.
No, Ginnie Mae does not directly market those securities, but you certainly could go buy them kind of from any of the other places you would normally buy securities from. But as an agency, we do not kind of sell securities to investors. No. I would say that I'd like to point out too that really Ginnie Mae has become an increasingly important part of the housing finance ecosystem, both domestically and internationally, because our program has grown tremendously in size. And I want to put up a slide right now just to show that we were at $350 billion or so before the last.
Let's get the slide up. Here we are. Philippa, thank you very much for that. Please, Seth, go ahead.
Yeah, so we were, you can see that we're now more than $2 trillion as of September 2020. We had a record volume year, issuing $748 billion in MBS through the end of September. So that's the fiscal year ending in September. And as this program has grown, it's taken on an increasingly important role in the housing finance ecosystem, as I mentioned, as a safe source of investment for global investors and international capital, as well as a great source of affordable mortgage credit for borrowers in the United States.
I would like, Philip, let's keep this slide on the screen, please, because there's some really interesting things to unpack in this, Seth, and to tell the story of the last few years. But before we go back a bit and look at September 07, 08 and talk about that and the differences, I'd like to go right to the far right-hand side of the curve as I'm looking at it. And that little dip, which I guess is when the pandemic hit. That is a V-shaped recovery if ever I've seen one. Yeah,
so the housing market has proven to be remarkably resilient throughout this pandemic. The fundamentals were much stronger than they were heading into the global financial crisis. What you did see is a dip as the industry kind of adjusting to those circumstances, right? So in the United States, the process of obtaining mortgage credit and closing a mortgage to buy a house has traditionally involved a lot of different actors and a lot of paper-based processes and in-person processes, such as home inspections and home viewings and signing documents in person and whatnot. And so because of kind of some of the state and local orders that were put in place restricting activity early on, that had an impact on volume in the housing market. Since then, the industry and government have really fast-tracked and evolved a lot of processes and procedures to make sure that housing market activity can continue, which has been really important because interest rates are at historic lows. They hit an all-time low for the 9th time this year in September, and so there's pent-up demand from those households that haven't had their income interrupted due to the pandemic. And so we're seeing robust activity continue in our programs.
But I mean, that little sort of, it's almost like a square root, but it's a V. So there was an adjustment process, but now you are very much back on the trend path that you were prior to the events of March, April, May, the height of the first wave of the pandemic.
Yes, that's absolutely right. Now, because we are operating in the government space and the underlying loans are kind of, again, for people that might not be able to access affordable mortgage credit easily in the conventional market, we've had borrowers, particularly in the Federal Housing Administration program, take advantage of forbearance, delaying their payments on their mortgages until a later date if they have had their income interrupted as a result of the pandemic. So we've seen certainly a percentage of the portfolio, I think it was the overall portfolio was around 9% or so in forbearance as of last month. But again, the vast majority of borrowers are continuing to pay. We've seen a lot of uptick in new purchase activity and new refinance activity due to low interest rates. And we have, our issuers, our counterparties are in good financial shape right now, by and large, and have been able to kind of advance principal and interest without difficulty.
We're going to talk a little bit more about this year and about your, the record issuance and that type of thing in a moment. But I'd like to go back in time to that very noticeable pivot point on this chart, which is, September 2008. Now, you and I are both old enough to have white hairs, nightmares, whatever you want to call them, about the autumn of 12 years ago. where we were actually very much around this time of year. I remember sitting at the IMF meeting in Washington and wondering whether any of us would have a job to go back to on the Monday morning. It was a scary moment. That was a pivot moment for Ginnie Mae, in that the curve is relatively flat. I mean, it's trending mildly downwards, and then suddenly you're initially on a 45-degree angle upwards. Why did it pivot so clearly at that moment, and what has sustained it throughout in that steep rise?
So the underlying government insurance and guarantee programs that go into the Ginnie Mae MBS are counter-cyclical in nature, right? So if the private market recedes, the private capital recedes from making those loans, then those programs attract additional business because they're backed by the government, and because they have the Ginnie Mae wrap on it. They continue to be viewed as safe for investors because of the full faith and credit guarantee. And so what you saw is a lot of the private activity, particularly a lot of subprime lending, go away, and folks that were availing themselves of credit in that market coming into the FHA, VA, or USDA program. So that's really what kind of what made the difference. And this countercyclical role is hugely important because it can expand and contract like an accordion and make sure that the demand is met no matter kind of what the circumstances are.
It seems though, however, I mean, that it may be countercyclical, but yours is a very clear growth trend in terms of the outstanding pools of mortgages, which would seem to me that it wasn't a temporary change. It's more of a structural change in the market. Is that those, particularly perhaps the subprime, the credit impaired, or whatever you want to call them, segment, has transitioned in the United States away from the private markets, which were at the cause of the financial, partly at the heart of the financial crisis in 2008, to more Ginnie Mae and similar type programs. Is that a fair thing to say, that there has been a permanent shift, you think, and we're not going to see subprime coming back into the private markets anytime soon?
No, I mean, I don't foresee subprime returning. I think there's a couple of other things at play. I think that was the cause of the original upward trajectory that was so dramatic during the crisis, was really that counter-cyclical role. Mm-hmm. A couple of other trends that are at play here too is that since the crisis, we really underbuilt housing to meet demand. I think from 2010 to 2016, we built about 7 new units of housing for kind of every 10 new families formed, new households formed. So there's certainly demand for these programs. There's demand for housing. That demand has caused prices to go up too in certain places. So that has caused kind of the MBS volume to increase. And then lastly, I would say, we've seen tremendous growth, particularly in the VA mortgage program. That serves veterans, military veterans in the United States. Those are typically larger balance loans with higher credit scores, but the down payment and terms are quite favorable. And so we've seen kind of a really significant growth trend in that program, which has contributed to this overall number.
Thank you, Philippa.
I would add one more thing too. I mean, the kind of regulatory changes that came into being after the financial crisis would make it quite difficult to go back to kind of the activity that took place before that.
Well, that's a very good moment to bring in our first question, because Mushtaq Parker, hello Mushtaq, nice to have you back again, who is a regular attendee on these things. And Mushtaq says, to what extent has the transparency of the quality of mortgage portfolios to be securitized improved on the 2008-2009 experience, when CDCs were given AAA ratings even when in reality they were effectively junk bonds. And I think the real sort of punch to his question is his final line. He says, in other words, how confident are you that we can't, not won't, but can't have a repetition of that experience? I think you've just touched on that, but that question being, do you now feel confident that the regulatory system in the United States is solid enough that there won't be a rerun of what happened in 08, 09, or 07, 08, really?
I do. I think that everybody, while it was, in some people's distant memories, I think that if you operate in the housing finance space, that it's kind of seared into the front of our brains. And I think that watching out for those trends and characteristics, is something that everybody does every day, particularly, in the government agencies. And so I don't think that it would be structurally possible to return to that type of situation that we saw. Now, certainly, as homes get more expensive, borrowers desiring home ownership might, try to reach and purchase homes that they're more expensive with lower down payments and using things like down payment assistance. But again, we're keeping a close eye on that, and so are the other agencies, and we want to make sure that the integrity of the program is maintained.
Mm-hmm. We've talked a little bit about this, but I think there's more to discuss, which is that one of the features of the 08, 07, 06, 07, 08 crisis, because it started earlier than I think a lot of people think. I mean, the November 2008 was the culmination of a long period of stress in the market. Was that the decline in the market was US-wide, the valuation, and it was a financial crisis. Now, the US economy seems to be recovering relatively quickly from the pandemic, despite the fact that the pandemic has not gone away. But you touched on this a little bit, but the housing market is geographically stable, is stable across income groups, but there must be some stress in it somewhere, because sure, there are sectors of the economy, hospitality, aviation, that are incredibly hard hit by this pandemic. So how is it playing out in the market? Are there pockets of stress? Are there areas of worry?
That's a great question. So I would frame it like this: I would say the people's behavior and really how they live their lives has changed as a result of the pandemic. Now that might reverse itself as more and more folks return to normal working habits. But with the shift to telework, there's been and schooling children at home as a result of the pandemic, families are particularly looking for larger homes, and also moving away from apartments in urban settings, trying to get more space in the suburbs, because if you don't need to live in close proximity to your job or your children's school, and you're going to need to have a home office, for instance, that makes your housing choices different. So there's certainly been a shift in buyer behavior as the appeal of the suburbs has grown at the expense of some of the quite expensive rental units in urban cores. Yeah. I will also say that the other place of stress potentially is going to be in the rental markets. Homeowners in the United States have a variety of ways to seek assistance. There's been moratoria on foreclosures and evictions and forbearance plans available to delay payments in the case of families with income interruption. Renters are covered by a variety of protections as well, but typically have less savings than homeowners, and typically work in industries that might be more susceptible to interruptions, such as hospitality So, we are watching the rental market very closely to see if stress manifests itself there. So far, it's been very stable because the government deployed a number of countermeasures early on in the pandemic, such as enhanced unemployment insurance and stimulus payments to renters. And that has allowed renters to continue to pay their bills. But, that's a trend that we're watching very closely as well.
When I glance to my side, I have a number of screens. I'm looking at some media coverage, National Mortgage News, talking about Ginnie Mae forbearance rates flattens, not flatters. I'm sure it does flatter too, but it flattens. Talk us through this word forbearance in two particular ways. First of all, to what extent have your the loans which you guarantee and under experienced the need for forbearance, and what specifically do you mean? Forbearance is almost by definition a temporary measure.
Yep.
Are we, and this is a theme we're having a lot in these conversations when we talk about the pandemic, is that governments, lenders, everyone is trying to build a bridge from one side of the pandemic to the other. Unfortunately, the canyon over which we're building this bridge seems to keep getting longer, especially if you work in hospitality. And I'm talking about the UK particularly, maybe less in the States. But what is it? How long can it last? Is there a likelihood that, say, sometime in the middle of next year, these things turn from forbearance into default?
Sure, that's a great question. So forbearance is essentially the option for an impacted borrower, someone who's had their income disrupted, lost their job, has another financial stress related to the pandemic, to delay their mortgage payment for some period of time. And under the CARES Act, which was signed by the president this spring, that forbearance period, it can initially be up to 180 days, and at the borrower's request can go an additional 180, so really up to a year. But it's very important to make the point that forbearance is not forgiveness, and so that is that the forborne principal and interest is due, and so the insuring agencies and the GSEs have developed a number of innovative strategies to help borrowers navigate this situation. There is not a lump sum payment required at the end of the forbearance period. There's what we call in our programs, a potential for a partial claim, which allows a kind of second mortgage to be tacked on to the end of the first one, so that you can continue at the same rate and payment every month once you resume payments. There's other loss mitigation options, such as modifications available. There's, of course, borrowers are able to refinance because of the rates hitting the low for the 9th time this year. So it helps. It's kind of a temporary bridge to help impacted borrowers navigate the uncertainty. But at the end of the day, there's still an obligation to make payment.
Mm-hmm. And it's for the initial period is 6 months, but there's an option to extend for another 6 months.
That's right. And we're closing in on the we've just hit really the first wave of the initial 6 month period is running out for many borrowers, or has run out for many borrowers in the last couple of weeks. And so we're seeing some, loans roll over into that next 6 month period. We're seeing others, go to this partial claim, and we're seeing others go to modification. And so all options are seeing activity right now. We have seen, though, the good news is that our forbearance number in the portfolio overall is down to between 9 and 9.5%. I think it was at 9.41% of the portfolio was in forbearance. This is down, substantially from where it was in the spring. And we're also within our insuring and guaranteeing agencies, FHA, which tends to serve more first-time and low and moderate income borrowers. is at 12%, whereas the veterans program is just over 5%. The rural program is at 8%, and the Native American program is at 3.5%. So we have kind of a different distribution of forbearance rates across the entire portfolio right now, but they're trending in the right direction.
And do they how does that compare with where you were a year ago or 2 years ago? What's the benchmark for forbearance rates?
Well, forbearance didn't really particularly
okay. Well, troubled loans, put it that way.
So delinquency is what kind of existed a year ago. And it's really been an interesting challenge to parse out kind of the difference between forbearance and delinquency, because we also saw a number of borrowers kind of preemptively go into forbearance, but continue to make their payments. But I think they were just trying to make sure that they had that as a backup plan. Yeah. So, you know, we tracked these things separately. Our delinquency numbers right now are actually a little bit different, and are a little bit higher than the forbearance numbers, and clock in at about 10.5% over the entire portfolio. That's a little bit higher than they were, particularly those that are kind of in the FHA program, but it's not outside of the realm.
Yeah. I mean, it's not what you know what I'm trying to get at here is that you're not sitting on any really scary numbers here that we're not hearing about.
No, that's right.
Are there any scary numbers there, Seth, is what I'm asking you. And the answer is, well, they're not brilliant, but it's to be expected given the circumstances.
Yeah, it's to be expected given the circumstances. And again, there's a number of options available for borrowers to navigate out of forbearance and to navigate the consequences of the pandemic. So we think that the tools are in place that will continue to provide stability to those borrowers, and it's our hope that as many of them as possible can resume earning their pre-COVID income and making payments as soon as they can.
Yeah, I mean, I think another difference between today and 12 years ago is the speed at which governments have moved. And now, there are issues in our country and yours on the fiscal side of the balance sheet where we can deal with that differently. But in terms of maintaining financial systemic stability, it was almost immediate. It was as near as immediate as I've ever seen any government act, to say, we are not going to let this become a financial crisis. And I think that should give everyone some form of confidence that, people are paying attention at the very highest level to that. Is that a fair thing to say?
Yeah, there was a whole of government response, and it was very swift and decisive. From Ginnie Mae's perspective, we knew that with borrower forbearance, as I noted kind of at the top of the hour, our issuers are required to continue advance principal and interest to investors, regardless of whether the borrowers with the underlying mortgages are paying every month. So we knew that had the potential, particularly for our independent or non-bank counterparties, to put a liquidity stress on them. So we immediately stood up a liquidity facility to provide financing for our issuers if they couldn't meet their P&I advancing obligations. The good news is we've had, and we publish data on this every month as far as usage, but we've had limited uptake on it because the underlying market, the purchase market and the refinance market have been so strong that there really hasn't been a tremendous uptick. But that was a key inflection point to send a message of confidence to the market that the government was going to do what it needed to do to ensure that it could continue to function in an orderly fashion.
Yeah, but this is a lesson that we all learned from 2008. If that hadn't been there, it's there, but you don't need it. But if it's not there, you're in real trouble, because it's all about the confidence, and that ripples through the system. And I think that's a great thing. You said you brought in this liquidity facility, this program. You touched again on this a little bit at the beginning about other things that you've learned as a result of the pandemic or changed. Digital collateral. You and I spoke about earlier on this week. Just give us a little bit of an idea, if you can, about that type of change that's come about as a result of this year's pandemic.
So as a government corporation, we can't always move as swiftly as the private sector. And so we've had a fairly ambitious long-term modernization plan that's been published out there called Ginnie 2020. We are in 2020 right now, but that was released a couple of years ago. But part of that was really focused on modernizing our platform and particularly being able to accept digital collateral for electronic promissory notes so that we can really modernize the way that we do business here and move into the future. So it's a huge technology upgrade and should make the system more efficient and more effective. That project was underway already, but as soon as the pandemic hit and we saw that there were going to be delays with in-person meetings and wet signatures on documents and things like that, we immediately put that at the top of the queue and prioritize it. And we're able to launch that pilot in the middle of the pandemic. There's been a lot of enthusiasm about participating in that. And we're hopeful that we can stand that up on a broad basis in the near future, because that is a hugely important innovation for this industry and for Ginnie Mae.
I mean, do you feel that that's sort of happening across the industry, not just with you, but that?
Oh yeah, I mean, I think that we've seen tremendous innovation. We've seen a huge uptick in remote online notarization. We've seen different changes in appraisal practices. We've seen obviously a lot more focus on e-notes, which we just talked about. I think that everybody's focused on how do we ensure that the market can continue to function and really thrive in a more virtual environment, which is an exciting thing for the entire housing finance ecosystem.
Excellent. Let's talk about, we probably got just over 10 minutes left. As Mushtaq is asking some more questions, I've got questions from a few other people that I want to bring in. There seems to be some questions on LIBOR, which is a subject I know very little about, but I will ask you because I think you might know more. But let's do that. Let's do that in a second. What I want to look at it's a good time to talk about that, but we'll bring it in as a supplemental question to what you see 2021 as being in terms of investors. I mean, most of the people involved here are either mortgage professionals from other countries or are investors in mortgage securities. Are you confident that 2021 is going to be a strong year for Ginnie Mae and Ginnie Mae related securities?
Oh yeah, I think it's going to be a really strong year. I think that we've proven ourselves throughout this crisis that this is really a very stable, attractive form of security investment for global capital. I would say that as far as volume, right, like the huge swing in interest rates caused a big uptick in refinancing transactions, which obviously affects prepayment speeds, and investors clearly monitor that. I do think that at some point we're going to run out of inventory to refinance. So I would expect that trend is not going to be as robust in 2021 as it would be in 2020, but we're still seeing considerable activity on that front.
And the low rate environment. One of my panelists on a previous session a week or two ago, ZIRP, he called it, zero interest rate policy. We were talking about something completely different, but that was his thing. ZIRP is a big thing. But the general view, I think, on both sides of the Atlantic, and indeed in other places, particularly, say for example Saudi Arabia, which is pegged to the dollar and follows, not completely, but follows US rates relatively closely, is that we are in a lower for longer
Yeah.
time. What does that mean for the investors in securities that are backed by Ginnie Mae? I mean, there is a pickup over treasuries, obviously, but it presumably is relatively narrow. So what is it that, why should I put my capital to work with you? What's that, and what are the likely prospects, do you think, for how that might change in terms of spreads or other things?
Well, look, my sales pitch would be consider the alternatives. I think that as you said, there's a premium over treasuries, but it's an explicit full faith and credit guarantee. So your investment is absolutely safe and secure. You know you're going to get paid on time and in full every single month, regardless of what's happening in the broader global market, and you're going to get a better return than you would on other similarly safe investments. And so that's really the attractive part of the Ginnie Mae security. It's certainly, its rates are certainly going to be influenced by overall interest rates, and we've seen that. But we do think that compared to alternatives out there, it's still a very, very good value proposition.
Do you feel that is, I mean, because, obviously it comes down to a sort of risk weighting of capital and, or risk perception and various different things like that. Do you feel that other jurisdictions around the world where investors are sitting understand sufficiently how to evaluate Ginnie Mae securities in, say, insurance companies or on pension funds, that type of thing?
So I think that investors understand it. I think that where we sometimes run into trouble are kind of international regulators. For instance, under Basel, Ginnie Mae securities receive a 0% credit risk weighting because of the explicit guarantee, whereas Fannie Mae and Freddie Mac on their securities receive a 20% credit risk weighting because of the implicit nature of the guarantee. But we go over to the European Insurance and Occupational Pensions Authority, which has its own credit risk rating framework called Solvency II. And under Solvency II, they actually assign a penalty of 100 to 250% credit risk weighting for Ginnie Mae securities. They don't recognize, guarantees that are in place by governments outside of the European Union. And so really this is a limitation on European investments by life insurance companies, pension funds, investors of that nature on our securities. And so we're actively working with our counterparts at the Treasury Department to try to change that treatment and change the perception of our program. But that has been, it's a great question, and really the regulatory framework is one that can kind of determine whether or not the Ginnie Mae is going to be an attractive investment for some of our international stakeholders.
Yeah, one wonders why they think that. It couldn't have anything to do with covered bonds or anything like that. Absolutely not. You didn't say it, neither did I. LIBOR. Now, we're getting into the weeds here a little bit, and I'm not going to pretend that I understand the new setup, but LIBOR is finished or finishing, and I know that impacts you. What, in as simple a way as possible, what does it mean for you that's changing, and what are you going to change to, and are you happy about the change?
So first, just for context, the vast majority of the Ginnie Mae program is fixed rate product right now.
Yeah. Interest
rates are very low. So, the adjustable rate mortgages are really kind of concentrated in some legacy product, as well as the reverse mortgage program, the home equity conversion mortgage program. But by and large, your forward mortgages from FHA, the VA, or USDA are in fixed rate. So we have decided, as my colleagues and I like to say, that we're trying to not dig the hole deeper as LIBOR is set to go away and, it become an unreliable reference rate, perhaps. So we recently announced that we will no longer be accepting the pooling of adjustable rate mortgages with rates indexed to LIBOR after January 1st, 2021. We think that that gives industry sufficient time to transition. We will, the other reference rate that's always been available in our program is the constant maturity treasury. In fact, the Department of Veterans Affairs loan guarantee program, the VA mortgage program, has historically used that exclusively. And so we think that a number of our participants will be comfortable utilizing that. I think eventually we'd like to see the development of SOFR-based product, but that will require some rulemaking by the Federal Housing Administration particularly. And as a government agency, again, we are not always able to react as swiftly as the private market. So that the main point is that for the adjustable rate product, we are no longer going to accept the pooling of those mortgages if they're indexed to LIBOR after the first of the year.
Yeah. Great. We've got actually, God, good Lord, it's it's later than I thought. I want to draw this to an end by talking about the importance of agencies like Ginnie Mae in the development of mortgage markets and the development of housing finance markets. So this series is thematic. The thematic arc of our series, which is running from September to the end of the year, is the development of a housing finance market in Saudi Arabia, a country which is sort of similar in size and GDP per capita to Canada and Poland. Sorry, GDP per capita to Poland, population Canada. So a lot smaller than the US, but that it is developing actively. Its mortgage market, it's growing hugely rapidly. And there is a sort of sister organization called the Saudi Real Estate Refinance Company, SRC, which is run by our friend Fabrice Susini. And I'd like to get your perspective, speaking ex officio as Ginnie Mae, about why entities like you are important and why it's important for countries like Saudi Arabia to support the development of these entities. What sort of roadmap do you think that they should have in order to do this?
Thanks for that question. And as on a personal note, one of my last trips I made before the pandemic was to Riyadh in February of 2020 to sign a memorandum of understanding between HUD and the Housing Ministry of Saudi Arabia. Was honored to meet the minister there and talk about the housing challenges that face both of our countries and citizens, and how to make sure that there's affordable housing for purchase available in both countries. And so as part of that, I did have a chance to meet with Mr. Susini and the team at the Saudi Real Estate Finance Corporation. We had a great meeting, and I was really excited about the work that they've done. They've really, the U.S. market is looked at as the housing finance system is looked at, as something that's very innovative and complex, but it took a really long time to get to this point. I mean, Ginnie Mae has been around for over 50 years. The Federal Housing Administration dates back nearly 100 years now. It came out of the Great Depression in the early 1930s. So, we've had a lot of time to try out different concepts and different ideas, sometimes successfully, sometimes unsuccessfully. It's just really exciting to see what the Kingdom of Saudi Arabia has been doing to develop a mortgage-backed securities market to really for the benefit of the citizens there. They have also a growing population with a lot of newly formed young households who have a demand for housing. And this is a way to allow those households to purchase housing earlier and get better quality and more affordable housing to meet their needs. So I think that it's a really exciting activity. We are here to provide all of the technical assistance that we can and support that we can, because we think it's good for the world, and we think it's good for the bilateral relationship between our two countries to collaborate on this project.
That's great to hear. I mean, was that your first time in Riyadh, or have you been there before?
Yes.
What did
it
you
was
think?
My first time there. I was only there for, I think, a day and a half. Hopefully, if I go back in the future, it will be for longer. But the hospitality was amazing, and again, I was very impressed by the sophistication of the team and the marketplace there, considering that is really in its nascent stage. It's really growing very rapidly year over year.
I mean, it only started really 3 years ago. It's quite, I mean, I'm an old Saudi hand, so, and I'm very fond of the country. I mean, like all places, it has its issues, but it's, it is not the place that people think it is from outside. And also the work that they've done, particularly in the housing and mortgage segment in, their government, but they've been moving at warp speed, is spectacular. And we were talking to Fabrice on this show a couple of weeks ago, and we hope that their first local sukuk will be this year, and there will be an international issue next year. I mean, obviously, we have to see things are a bit tricky, but they're tracking on to sort of joining you. They were probably not at $1 trillion yet, Seth, but 2.2 trillion or whatever. But they'll get moving in the right direction. I think we probably have to draw it to a close. Mushtaq, I hope you feel we answered some of your questions. Some of them I think are a little bit perhaps too technical for us. So at about, we're just approaching 5 minutes to the hour. We will, I think, call it there. Seth, first of all, thank you so much for joining us.
Thank you.
Really appreciate you giving up the time in your day to talk to us and to the Euromoney audience around the world.
Thank you so much. And again, one of the exciting parts of the Ginnie Mae program is that if there are technical questions, we post lots of data disclosure on a monthly basis so that you can see exactly what's going on in the portfolio of $2 trillion. And so we're committed to transparency in that regard, to make sure that our stakeholders and investors know exactly what's going on.
And you have a great international investor relations guy in Alvin Lamb, who is a good friend of mine and someone I've met on many occasions. And I know that he does outreach to people all the time. So if anyone watching wants to know that, do get hold of us or go directly to Ginnie Mae. I'm sure they will be glad to help you. Before we close, I just want to do a bit of a commercial for what's coming up on this channel. Next week, we will have, well, the thing you can see in the front of you is the next in this series, which is another international interview with Chung-Chi Leong from Kagamas, which is, Seth, is your sort of counterpart in Malaysia. So that's in the housing finance series. But next week we still have things coming up even that aren't housing finance. On the 28th of October, we have Jessica Roldan Peña, who is the chief economist of Finamex. She'll be on the show on the 28th. On the 4th of November, we are interviewing, I think I am interviewing His Excellency Mr. Mohammed Al Gwais, who is chairman of the Capital Markets Authority from Saudi Arabia. And then on the 16th of November, we have, as I said, Chung-Chi Leong from Kagamas. So a lot's coming up every week, at least one a week until the end of the year on a variety of different topics. So do visit our website, euromoney.com/livestream for further information. I'd just like to thank our partners, the Real Estate Development Fund in Saudi Arabia and the Ministry of Housing, and of course our co-sponsor, which is Samba. Recently announced that it will become Samba NCB, or rather NCB Samba. We don't know which one, but great bank, great people, great to have their support. I commend them to you highly. Finally, I want to thank the Euromoney team, as always, working from home, Filippo, Victoria, and the others, Xanthi, I always forget exactly who's in, Gabrielle, there's a load of them, Mohammed, of course. So a big team of people put this together every week. We're all still doing it remotely. Your thanks should go to them. And that is all we have time for today. It's been great. Seth, it's been lovely to have you on board. I hope to see you in either in DC or Riyadh or somewhere else sometime relatively soon.
Thank you very much.
Great. So with that, thank you all very much and good afternoon.